Today on Think Smart with TMFG, Mike and I are going to be talking about what has happened to the Canadian stock market. Mike, I'm past 30 years in this business. And when I joined the business, the Canadian stock market, it was called the TSX 300.
Yeah.
There were some great companies in there. There were some great businesses in there.
It was exciting. And at that time, it was a lot of oil companies, financial companies, some interesting high-tech companies. Canada had some, interesting plays in there. Yeah, it was a pretty interesting marketplace.
So I thought it might be helpful to just look at the Canadian market today. So what I did to do this is I went and looked at the top 250 companies in Canada today and just started just had a look at them and started, doing some counting. And then I was able to go and do some comparisons to the U.S. So let me start with some companies that have disappeared over the last 15 years. Nortel was a $300 billion company at one point.
Big by today's standards. Yep.
It'd be the biggest company still.
Yep.
15 years later at $300 billion. It'd be bigger than Royal Bank, which is at $250. So they disappeared in 2009, and we all know that story. Pengrowth Energy in 2020, just 5 short years ago, was a $10 billion company. Rona, $3.2 billion in 2016. They were purchased by Lowe's, no longer a Canadian company. Imris was $300 million company, disappeared in 2016. WestJet went private, $4 billion company in 2019, purchased by Onyx. Next up was Alcan, 2007, a $30 billion company, purchased. And finally, Aeroplan, wasn't huge, $2 billion company, disappeared again. So what you're seeing is a lot of these companies are disappearing. And so
many times being bought by U.S. companies.
They are foreign companies.
It's
Whether
funny.
it's that they want our resources, they're coming in and they're buying the company.
Trump is going to take over one way or the other.
Well, let's hope not. So I wanted to see, how many big companies are left in Canada. So I said, let's use a nice round number if they're worth more than $100 billion.
Yep.
That's a lot of $1 billion, right? So in Canada, we have 8 companies that are worth more than $100 billion. Mike, who are some of those companies?
3 banks are going to be up there. So you're going to have RBC is going to be there, TD, and then Bank of Montreal are going to have 3 major players in there. I mean, beside that, when you go beyond the banks, you have Brookfield Properties, you have CP, Canada Pacific, you have Enbridge. One of the more modern players into the high-tech field, we have Shopify, which is a world leader. And again, going back to an old company, when we go with the opposite of Shopify, we go to Thomson Reuters, and that's a very old-school company in Canada.
It's interesting. We have a new background in our Zoom rooms, and it's a picture of the Toronto skyline. And what was noticed is that all the tallest buildings in Toronto, except for the CN Tower, are literally the banks.
Yep.
So the biggest company in Canada today is RBC at $252 billion. In the number 2 spot would be Shopify, which is a tremendous at $213 billion. So let's go down south of the border. How many are over that $100 billion?
50 companies in the U.S.
50. In fact, they have 8 companies that are over $1 trillion. So just think of that. 8 companies are over $1 trillion. Canada's biggest is 250. So those are 4 times the size of our biggest company, and they got 8 of them.
Yep.
Maybe it's just there's not a lot over $100 billion. What about over $50 billion? Those are still substantial companies. In Canada today, there's only 13 companies in that group. Yep. In the States, if we go down to $10 billion, there's 800 companies over $10 billion in the U.S. It's huge. So why are we bringing this subject up? What's important here, Mike?
Well, people are always talking about diversification. Some people have got away, years ago, portfolios would get away with just investing in Canada. You'd see the stock brokerage portfolios, and they'd have all Canadian stocks. Nowadays, you can't do that. You miss out on too much. The reality is you can no longer have a well-diversified portfolio that is just invested in Canada. You need to bring in those other countries.
So we need global diversification. Canada's only 2% of the world's stock market. U.S. is about 60% of the world's stock market. So once you start getting outside of Canada, you get to see better opportunities, more profitable companies, larger companies, smaller companies, mid-sized companies. It's like you're at a restaurant and the only thing you can have is the burger. When you get to go, this is like going into a grocery store. You can buy what you want at whatever price you want.
Well, the problem is, like, if you come in Canada and you want to buy a good high-tech company, Shopify is your choice. U.S., think of the choice you have. You have Apple, Microsoft, and you have just a slew of like 100 different great companies you can buy. And you get in that situation in Canada in a lot of different areas. We have one good company that covers that area. The only thing we have really a good position on is the banks. And that's about it.
The banks, and we've got some great resources companies still, but we've let a lot of them go to foreign buyers.
Yep.
Why is this happening? Why is the Canadian market shrunk? And, there's a number of reasons. We know the market size is smaller. So just right off the bat, you're comparing the Toronto Stock Exchange versus all the different exchanges in the U.S. Right away, it's a smaller game we're playing here. We have a resource-based economy. Once you take out the banks, all that's left are the resource companies, and resources are extremely volatile. They're in demand right now. Who knows, 5 years from now, they may not be in as high demand. In Canada, we have very limited venture capital. Very limited money is raised for new ventures. The government doesn't make it easy. They've continued to tax corporations, large and small, startups, and they've made it really difficult just from a financing point of view, but also from all the regulations they have to go through just to get their business going.
And even the attitude, if you go toward the U.S. versus Canada, it's a very entrepreneurial attitude in the U.S. As they say, it's almost like a badge of honor. They won't even talk to you if you haven't been bankrupt in the U.S. That's sort of how that works. In Canada, is a much more conservative type of nature, and there's a lot of government jobs in Canada, and again, that creates a more conservative nature of Canadians.
Very few mergers and acquisitions are not enough compared to what's going on in the rest of the world. Companies are starting to choose to list in the U.S. even though they're a Canadian company. Why would they do that, Mike?
Just more exposure.
More exposure. You get to be part of some of these huge index funds. Suddenly you're included in the index fund, and your stock always has money coming into it to push that price up to it.
Yep.
Huge. High regulatory barriers. We have barriers restricting even between provinces. Forget free trade. We can't even trade freely across our own border.
Yeah.
Investor preference for U.S. companies. Now, that's been more recent in the, last 10, 12 years.
Yep.
But the U.S. market is so broadly diversified. If you got a good business, you'd want to be listed there too. Some companies are starting to say, I may need to not just move my manufacturing, I may need to move my head office there.
Yep.
And that's not good for Canadians. The other thing that I think is the U.S. market is extremely liquid. Canada, because it's more concentrated, isn't as liquid. You want to get out of a stock, you might drive that price of that stock down by just trying to get out of your 10,000 shares that you own of a company.
Well, I think the problem, too, is the whole world wants to invest in the U.S., right? Everywhere you look in Europe, you go to every country from South America to Canada, we're investing in the U.S. I can't see many countries really concerned with trying to get their Canadian piece of their portfolio filled. It's not what they're going to try to do. So it doesn't have the lure to get people into there.
So you think if you're a buyer over in, say, Germany, you don't need to fill your 2% of your portfolio with Canadian companies?
I don't think that concerned with it.
It's probably not that urgent. Yeah. Do you need to fill your 60% that are U.S. companies?
It's like, are you worried that we have enough Finland in our portfolio? Well, it doesn't come up in conversation.
Very
right?
good point. Very good point. So where's all this leading? Mike, have we reduced our Canadian equity exposure over the years?
We have been reducing it. Slowly each year, we take a look at what Dimensional, we take a look at their portfolios, what they've done. They've continued to move a bit more to the U.S. And the size of the U.S. marketplace is just, they're not making any real judgment calls. The U.S. marketplace is continuing to expand. They have to profile that in the portfolio.
So we're still staying invested in Canada. We're not recommending getting out of Canada. I think it's important. We spend Canadian dollars. We live in Canadian dollars. We live in Canada. We're comfortable with the names. Everybody needs a home bias. Our home bias does not need to be 40% of our portfolio. It probably needs to be 20 to 25%. of your equity portfolio. And that's more than enough.
Yep.
That brings us to the end of another week. This is Rob and Mike with Think Smart from the McClelland Financial Group of Asante Capital Management.